When you think about the evolution of the internet, what similarities do you see within the digital asset space in terms of how that's progressing today?
Yeah, so it's very similar to us. So, I happen to have managed our technology mutual fund during the dot-com era. And it's very similar in that, back then, one, we heard the same kind of issues, concerns about regulation and things of that sort. And, people used to say the internet's only used by criminals, and, the government wanted to be able to track the users of the internet so they could track their wallets and the addresses of people that were logging in onto the internet, things of that sort. So the government created regulation that allowed the internet to thrive. And we think it's going to be similar to what happens here with distributed ledger technology and blockchain. But also back then, originally when we were looking to invest in the space, you're meeting with these companies and they didn't make any money. They were barely, they were just now getting started on revenue. They were pretty early on. And, the concept of the internet, we couldn't really get beyond. Originally, it was kind of like an online library, which you could go on, you could pull up information, you could read information, but there wasn't a lot of interaction there. Wasn't a lot of payment transactions going on. And, people were just interested in driving people to their website. And you say, well, how do you get paid? And it's going to be about eyeballs. The more people we get looking at our website, we'll have banner ads and people can click on the banner ads and we're going to make some money. It wasn't until we started having meetings with companies like Google where they were kind of creating a bigger picture of the future of the internet and how that software, the internet was just software, and that software was going to create productivity across many different industries. And it's similar here. Once we realized that distributed ledger technology is just software and how that software creates efficiencies and helps with productivity, then we'll see how large those applications can really be. So one of the things I'm constantly reminding myself is don't think of Bitcoin as coins, think of or tokens, think of the Bitcoin network and think of the software and how these various protocols, HTTPS is a protocol that's used for the internet or is the backbone of the internet. And these different protocols will be the backbone of these various blockchains and how we use distributed ledger technology.
I guess, can you talk a little bit about sort of opportunities today in digital assets, DeFi, distributed ledger technology that you can compare to kind of the dot-com boom that happened in the late 90s? And anything you could talk about in terms of valuations also, I think would be really helpful.
Yeah. So, one of the easy things that or the ways that we think the adoption gets done is the same way we saw transactions or e-commerce being adopted back in the dot-com era. So, we think of Amazon now and everyone's comfortable with making those payments. But in early 2000, most people weren't comfortable with going online and putting in their information, the credit card information, and actually making a payment. And, those companies, like the usage really didn't pick up till, after 2000. And I think a lot of that had to do with the fact that people adopted the technology, didn't realize they had adopted the technology. And I think that's kind of the way technology is best adopted when people are using it and they don't even, they don't have to change how they do things on a day-to-day basis. So, I would talk to people all the time. Hey, have you made a purchase on Amazon? They say, no, I won't do that. And I don't want my information on the internet. And I'd say, well, when you hand your credit card to someone after we have dinner here tonight, and they go in the back and they put it in swipe it in the POS system, that information is on the internet. You just didn't type it in. But it's on the internet. And so once I think people started realizing they had been using the internet for transactions, they became more comfortable with that. And I think it's going to be a similar kind of use case here where payments is probably the easiest on-ramp to using blockchain. And we're already seeing that with Visa and MasterCard. So today, like 20% of settlements on the Visa network are actually done on blockchain, but people don't realize that. So, people are sticking their regular Visa and MasterCard in the POS system, and it starts off on the Visa net, which is their payment network, but it's actually settling on a blockchain network in the background. So, I think that's the first adoption and kind of easy on-ramp to people getting familiar with that. I think that translates further down into Visa using stablecoins. Already Visa and MasterCard accept stablecoin payments. And I think stablecoins become more utilized, especially for cross-border transactions. So you don't have to pay for the FX or the exchange fees and things of that sort. So I think that's kind of the on-ramp to how that adoption occurs. And I think it's very similar to what we saw, like I said, in the tech days. The difference in valuations now, when we were investing back then, I mentioned earlier, most of those companies didn't have earnings. They didn't drive a lot of revenue or generate a lot of revenue. And today, the companies that are publicly traded, the majority of them actually make money, and we can actually create models that, and do valuations just based off of a regular PE multiple rather than having to come up with some kind of elaborate, multiple on revenue or EBITDA and things of that sort. So it's pretty. It gives you the confidence to know, okay, here's a real company that has earnings, and we don't have to have crazy valuations to invest in them. And we think there's a lot of upside potential for this software to be applied to multiple industries. And this is kind of just the early stages of how that software is going to be applied.
When you think about the financial services category specifically, what are some of the implications for this technology and what could potentially get disrupted?
Yeah. So I think the first case that we're already seeing is on the mortgage side. So Figure Technologies, which was founded by Mike Cagney. He actually has a company now that has been doing mortgages using blockchain. So every time I refied my house, it's 7:30 on a Sunday night. It took like 20 minutes for approval. The cash was in my account in 36 hours. And that's because there was a regulatory reason why they have to wait that long before they put my cash in my account. But that mortgage was recorded on the blockchain. And so they take those mortgages and they do securitization. So they've done multiple securitizations now for many banks. They were doing it only for themselves, and now they're actually working with several banks. And so they've done multiple securitizations last year, the smallest of which was a $200 million securitization. They don't have to have a third party involved there, like an investment bank. So there's less fees for them. There's more transparency in the securitization pool. So, if you're a purchaser of that securitization, you can see which mortgages are in that pool. And it just makes the transaction once again more frictionless. And so we think that's really the first application there. We do think there's many applications across trading. Right now you can trade cryptocurrencies 24/7, 365. We've seen already the SEC has approved IPOs of publicly traded companies, so equities that have been done as token offerings, and some of those trade on exchanges. So we think in the future there'll be additional IPOs that are done in a tokenized format. And we think down the road, right now when we trade, everything's digital. We're not actually getting physical stock certificates. So there's not much difference between trading a token and having the problem is the back office. So if you want to do these transactions on an exchange that's using blockchain, you settle real time. You don't have to wait 2 days for settlement. You can eliminate some of those back office fees, and there's transparency across the blockchain. So for instance, when we look at the Bitcoin blockchain, it's 13 years old, but we can go out and you can look at every single transaction and look at what wallet the transactions are coming from and are involved in the transactions since the beginning of the blockchain all the way through to 10 minutes ago. So, we think that application is just really an easy one. And unfortunately or fortunately, I think we'll be trading equities around the clock fairly soon.
Great, thank you. And to maybe change topics a little bit, we've all seen what's going on with the NFTs, and the ones that tend to get the most press seem to be the most ridiculous. How are you thinking about that category, and what's the real business use case there? Because I know you believe there's a pretty strong one.
Yeah, so I think the non-fungible token or NFT space is one of the big spaces here and one of the bigger investment opportunities in the future. So non-fungible tokens, basically, they're just unique tokens. So that means it's just one of them, non-fungible. And the use case for them is, so NFT, don't think of it as, what we've seen in the press, like Bored Apes and all these JPEGs and things of that stuff. They are digital ownership rights, and digital ownership rights that can be used across many different industries. And the really great part of them is you can sit smart contracts on top of them. So one of the examples I like to use, for instance, I'm a Sixers fan, and the Sixers played the Lakers last night. And so I actually had someone call me and says, hey, if you want to use my courtside seats, I'll sell them to you. It's the Lakers and LeBron, though, so I want $2,000 per ticket. And, while I thought that was crazy, somebody probably bought that ticket from them, or the 2 tickets from them. Now, the Sixers, he's a season ticket holder. The Sixers weren't going to benefit from that secondary sale. But if the Sixers actually issued their season tickets as a non-fungible token with a smart contract on top of it, they can have it set up where if there's any other secondary sales, they would participate. They could take a 5% fee off of each secondary sale, so that if it's resold in the in the open market, they actually participate in future sales. So I think that that's one of the easiest applications I was said. But I think that there's a lot of applications for NFTs, and if we just think of them as digital property ownership rights, and then the ability to put smart contracts on them so that transactions occur automated without having to someone actually having to kind of manage that process. I think people can really see how powerful that application can be.
Could you talk a little bit about how NFTs can be used to validate validate the authenticity of goods out there, that there might be counterfeits or fraudulent items made that are sold on a secondary market, and NFTs make it a lot easier, from what I understand, to do that.
Yeah. So that is a good use case as well, and we're seeing that out there. Kevin O'Leary, or Mr. Wonderful, who many have seen on TV, and one of his use cases that he has out there, he's a big watch collector. So I mean, when I talk about a big watch collector, he's buying watches that are six-figure watches that he keeps in vaults offshore and things of that sort. So for him, his risk of a transaction is actually buying a watch that is not the original watch or not what he thinks he's buying. So every time he makes a transaction, he'd have to bring it to a third party that would look at that watch and verify whether or not that was authentic or not. And he had to trust that that person knew what they were doing. But he's now working with different companies, and as they are producing these watches, and actually some other collections are going back and doing the same, they're actually dropping in these micro kind of identity numbers on them, and they're able to link that to the blockchain, to various blockchains. So one, if Stephen Russell was supposed to be the person that owned that specific watch, if someone else came to him to sell him that watch, then he would know there's either an issue, either the person stole it or it's not an original watch. But he could also look at whatever that serial number was on that watch to make sure that that's the same watch that is being presented to him. And all that information is out on the blockchain. It's open to the public, so you can verify that. And so from the beginning of that watch's life until whenever in the future, all those transactions would be caught on the blockchain and by a third party. And so you have that trusted information. You don't have to spend money on going out and getting, things authenticated, and you're not. Also, you can reduce the fraud in the market.
As it relates to your fund specifically, could you just kind of bring things into focus for us and talk about a good expectation that advisors can set with their clients when it comes to return and risk, and also talk about where we are in the life cycle of these new technologies and the firms you're investing in today? Yeah.
So I'll start with just in the life cycle of distributed ledger technology and kind of the digital ecosystem. And I think we're still very early here. So I think, this is once again like pre-dot-com era investing in the space. I think many people don't understand the space. I think companies are just starting to adopt. I think the use cases and the adoption by companies will continue and will pick up, like we said, once we see more regulation come into the space. And for us, the way we're looking at our fund, we're still that financial and banking innovation fund that still has to be, 85% of the fund has to be in banks and financial innovation. 25% have to be in banks at all time, but our banks that we're invested in have adopted technology, and some of them, the main kind of focus of their business is payments and using blockchain as payments for their B2B businesses and things of that sort. So even in our traditional names that are in that fund, we think we have some exposure. So we think that our 40 Act fund is actually one of the most diversified ways to invest in the space because we're invested across multiple industries, we're across multiple companies, and we're across companies that are using multiple types of blockchains. So we think it's a very diversified way to get exposure to the space. It is a volatile space. The way our portfolio is kind of constructed, at some points we're hoping that, some of that bank exposure that are more traditional banks helps mute some of that volatility. There's going to be volatility when you're investing in a technology space like this. So we think that, that's something that we think may help mute some of that volatility. But there's definitely going to be periods of volatility. And, as right now here at the beginning of the year, we're seeing a lot of these names just all trading together, even, despite the fundamentals, and despite the valuations that are out there. We've got valuations that are pretty attractive on companies that are earning money. So we're not, using multiples of revenue. We're actually having, single digit PE valuations. So, yeah.
Could you just give kind of what you see in terms of the banking industry opportunities or headwinds that we might face going forward?
If rates are going up, some of our banks or some of the banks out there won't benefit if they had loan floors. So a lot of the banks will have loan floors. So their rates didn't come all the way down to where the market is. So there could be 1 or 2 rate hikes before the rates actually get above where their loan floors are on their variable rates. So they actually don't benefit from maybe the first 2 rate hikes, right? On the flip side of that, your deposit costs right now are extremely cheap in the market, and deposits are extremely abundant. Typically, you have 1 or 2 rate hikes before deposit costs. So deposit costs usually lag rates going up, loan rates going up. And that's usually 1 or 2 rate hikes before you start seeing deposits move. But there's so many deposits in the market right now, it could be longer. So there's some uncertainty about exactly how beneficial these rate hikes are going to be to the bank. The other thing is, we worry that if you have too many rate hikes, then on the flip side of that is it could slow the economy. And if you have a slowing economy, then you're going to have less borrowing. And a lot of these banks that are out here, if they're traditional banks, if they're spread lenders, and you have a slowing economy and less borrowing, obviously, then your net interest income is going to be less. So there's still some uncertainty. And then also during this reporting season, we finally saw on the SG&A side, a lot of these banks had increased SG&A because of salary increases due to inflation. So there's still some uncertainty out there in the market for the banks right now, and how fast rates go up and how fast those rates start to benefit the balance sheets of these banks.